Hey, how's it going, everyone? My name is Amos, and welcome back to the Dividend Compounder Show. What if I told you the best way to build wealth is through real estate? And no, you don't need to spend millions of dollars to be invested into those buildings and properties. You can just buy REITs, which are real estate stocks. And the best part is they pay a very high dividend yield, and as a sector, they're on a massive discount right now. So if you are a value investor that likes to buy high quality compounders on sale, then REITs should be on your radar. So today in this video, we're going to be doing another ranking tier list for REITs specifically. And by the way, this is part 3 of the series of ranking different companies in different industries and sectors or titles. So to keep things as objective as possible, the 3 metrics that we're going to apply to all of these companies, number 1, we're going to be looking at their adjusted funds from operations. When it comes to the real estate industry, you can think of the AFFO as the free cash flow. And then number 2, we're going to be looking at their dividend profile. And when it comes to the dividend, what I care most about is not just the high yield, but I want to know, is the dividend going to be sustainable, and are they going to continue raising it in the future based on their AFFO? And then finally, we're also going to apply the metric of their occupancy rate. When it comes to REITs, you own a bunch of properties and then you rent it back out to your clients, to your customers, and so to have a higher occupancy rate is a better thing because you're making cash flow from your assets, if that makes sense. And I tried my best to include all of the popular REIT stocks that we all know and love, but I couldn't fit all of them here. And I promise I'm not a racist, but we're going to be looking at the top 16 that I think are the most popular among the dividend community and on Wall Street in general. 16 different REITs, and we're going to be grading them from a scale of an S, which is going to be the best, absolute, beautiful, all the way down to an F. If a REIT is placed into the F category, you basically want to avoid it, like the hole that's in your underwear that just seems to get bigger and bigger with each wash and load. Anyways, let's go ahead and get started. The first REIT is going to be Prologis, ticker symbol PLD, and they're in the real estate business of fulfillment centers, shipping facilities, and distribution access points. Anything to do with the transportation logistics industry, Prologis is the way to go. For instance, all of the different small startup e-commerce companies, they usually partner with Prologis to rent out a warehouse so that they can run and operate their business. And as a result, this company has just been skyrocketing for the past 4.5 years as e-commerce becomes more and more prevalent in the business sector. So as of right now, they're currently trading for about $117 a share. The market cap is about $108 billion, so that's a pretty big company in the stock market. Their PE ratio, which is the trading multiple in terms of the FFO, is about 20.5. The sector average is about a 15.9. So if you look at their historical trading multiple, it's usually at around a 26.7, meaning that they're currently on a discount in terms of their valuation and how the market usually pumps them to be a more premium real estate stock. And when it comes to the metrics of how you evaluate a REIT, this company actually received a perfect 100 out of 100 score. And when we consider the total return for Prologis with the dividends taken into consideration, past 5 years it went up by 51%, and in the past 10 years we're talking about 260%. So pretty good, pretty decent. The dividend yield is about 3.2% as of right now, which means for every share of Prologis that you have, you get paid $3.84 a year in dividends. But anyways, they've been growing their dividend, this right here, at a rate of 10% year over year, which I think is pretty good. And when you think about the past 5 years, it's been growing at a rate of 13%. The payout ratio in terms of the AFFO, 67%, very sustainable, very good. And as we take a look at their dividend history, it's every 3 months or every quarter, and just look at the beautiful trend going all the way back to, 2022, 79 cents every 3 months. We keep going back in time. Right before the pandemic, they paid 53 cents every 3 months. And this is just a company that is a juicy dividend compounder. And as we scroll down to take a look at their finances, the thing that I care most about is their FFO, the funds from operations. And as you can see, in the past 5 years, the CAGR is 17%, which is pretty impressive and a very bright thing to see from a REIT. However, one thing that I do want to call out is from 2023 to this past year, it does look like the FFO did in fact decrease slightly year over year, which could be a call out for, is their growth over? Are the best days behind them? Because to go down -1%, is that going to be a trend for the following year? That is something that you want to be mindful of. And their occupancy rate for all of their warehouses and distribution centers that they have available, they have about 96% of them rented out to paying customers, which I would argue is pretty good. I think anything above 90% for this occupancy rate metric is a good thing. But their FFO, I think, looks pretty solid. Their occupancy rate is pretty decent. I can't say the best because the best would be somewhere like a 98 or 99%. But I think this is actually really respectable as well. And for their dividend profile, I thought it was pretty good. It looks sustainable, healthy, and the growth rate is really amazing. I think there's a lot to like about this company. So with that said, when it comes to Prologis, I think we're going to have to categorize them into the E tier. I'm just joking with y'all. I think right now, we started out the video with a bang. I think for now, let's go ahead and put them into the category of A. They have an A grade as a REIT. Is that fair? I think it's not too bad. The next REIT is going to be Equinix, ticker symbol EQIX. And they're in the business of renting out facilities that are focused on caring for and maintaining data centers. And some of their customers include Amazon, Microsoft, Google, Oracle, IBM, Spotify. Anybody that is utilizing a cloud server or network, they're going to be renting it out from Equinix for the most part. So in my humble and hairy opinion, do I see a bright future for them? Absolutely. At least for the next 10 to 20 years, Equinix is going to be a shining bright star, like your kid that performed in the school play. And as a REIT, they received a grade of a 93 out of 100, and that's because their debt to their asset ratio is not exactly the best, but a 93 is still pretty impressive. They're currently trading for about $930 a share, so not exactly the most affordable thing. But check this out. Back in 2019, right before the pandemic, Equinix was trading for roughly $500 a share, and since then it's just been ballooning in valuation and skyrocketing. Case in point, their trading multiple, when we take into consideration their AFFO, is a 27. So their PE is the exact same as AMD's forward trading multiple. And their market cap is slightly smaller than Prologis at $90 billion. And when you take into consideration their total return, while thinking about their dividends, for the past 10 years, that's 421%, which I would argue is pretty good. When we take a look at their dividend profile, the yield is 1.8%, which for a REIT is really low. It's not impressive whatsoever. A 1.8% is what I would expect from like a company like Home Depot or even Lowe's. But for a REIT to be less than 3 or 4%, not the biggest fan here. But is it going to be healthy and sustainable? Absolutely. The payout ratio is a 49, which I think is pretty good. And they're growing their dividend. This number right here, $17, the payout seems pretty impressive until you remind yourself like, man, this thing costs more than my cell phone. Crying out loud, like I paid $500 for my iPhone. Equinix is $930 a share. Costs more than my freaking iPhone. But anyways, they're growing the $17 dividend payout at a rate of about 12.6% year over year for the past 5 years. And if you just look at most recently, then it's 17%. So the dividend profile overall is below average, but it is healthy and sustainable. And they are growing it at double-digit rates. So we do got to give them props when it's due, but a 1.8% for a REIT, I don't know about that. And then when we look at their AFFO, it is growing at a beautiful rate. For the past 5 years, they grow 10% year over year, which I think is pretty impressive. And most recently, in 2023 to 2024, it went up by 8.6%. So I think their growth of their free cash flow, quote unquote, pretty impressive, pretty good stuff. When we look at their occupancy rate, though, not good. And I say that because it's kind of declining from their high of 2022 of an 82% of all the facilities of data centers that they rent out. It dropped down, and now it's sitting at 78%. This is concern for me, and I would argue is a valid yellow flag. I agree with this color right here, saying, okay, this is not the best thing in the world, but at least it's not down, at like a 50% rate, which would be atrocious. So their dividend profile, I would argue, is just average. However, in the realm of REITs, I would say below average. Their occupancy rate also below average. Their AFFO, their total return, and their other financials look pretty good. So all things considered, when it comes to Equinix, I know they are performing really well for their stock price, but for what we are looking at, the metrics, their dividend profile, their occupancy rate, and the fact that if you buy into them right now, you're not exactly getting the best deal. I think their run-up shows if you buy into it, you believe that they're worth a 27 trading multiple. With all that, I think we're going to have to put them into the D category. I know it's an absolutely diabolical scandal of a rating for Equinix, but I think it is a solid company. Maybe I'm being a little harsh. I think let's just go ahead and put them into the C for now. I might change my mind a little later, but if you disagree with me, you got to let me know in the comments section. I think they are a really good REIT, but for a shareholder and an investor, you're not exactly getting the best bang for your buck. Does that make sense? I think Equinix will give you the total return that you seek, but if you're looking for that dividend payout and to know that this company is renting out 95 or 97% of their data center facilities, you're not going to get that from Equinix. So the facts speak for themselves. All right, friends and family, the next one is going to be American Tower, ticker symbol AMT. And they're in the business of renting out cell towers internationally. I know, their name is a little misleading because you would assume that they only operate in the US, but a majority of their income is generated overseas. And when we take a look at their grading for a REIT, they got an 88 out of 100. Every other metric received a full marks, but their debt is not exactly the prettiest picture in terms of their assets and what they're doing with it. That is something that you do want to be mindful of. The price right now is just shy of about $190 a share, and it looks like in the past maybe like 5 or 6 years, they had this massive run-up where they reached an absolute high back in 2021 of $268 a share. And since then, it's been kind of flat, kind of on a decline, but it is what it is, $190. I think that's pretty good. The market cap is very similar to Equinix at about $88 billion. Their trading multiple is an 18, which I think is kind of low for what they're doing, the business that they're in. Their total return for the past 10 years, we're looking at 139%, which is kind of low, if we're going to be honest. If we're going to be transparent and truthful, I think that's kind of low for a REIT. And when we look at their dividend profile, their dividend yield is 3.4%, which means for every share you get paid out $6.48, which I think is pretty good. And it's been growing pretty consistently throughout the time. But it looks like, as you can see right here, in December of 2023, they paid out $1.70 that quarter. But as we fast forward, the growth did not keep up because the following quarter, they paid out $1.62, so the growth went backwards. But all things considered, their dividend growth for the past 5 years is 5.8%, which is pretty good. The dividend payout ratio, 64%, sustainable. Dividend yield, I would argue, is not bad. It's above average for a REIT, but it could be higher. The dividend growth, I don't like this picture right here, because for a REIT, you want to see this number be growing year over year, right? The payout ratio I like. I think that's good. And when we look at their financial, this is kind of interesting because for the past 5 years, their AFFO is growing at a rate of 2.6% year over year. So they posted $4.9 billion in AFFO, which I would argue is pretty decent for a cell tower rental company. And because they're in the business of cell towers, they don't exactly have an occupancy rate. So what you see right here is, oh, their largest tenant is T-Mobile, and they own about 18% of all of their cell towers. And I'm assuming this color is yellow because you don't want to have too much exposure to one single tenant, because if they go under or they go through a scandal or they experience a setback and they have to cut ties with you, that's a majority of your portfolio that's going bye-bye. So that I'd see why this color is yellow, but I don't think that's of concern because when you think about T-Mobile, they're one of the hottest, most successful cell phone companies right now. So when it comes to American Tower, it's kind of like Equinix. They have some goods going for them, but they also have some negatives. The negative would include their dividend profile and how their dividend growth went in reverse and declined year over year. But the payout ratio did signify that it's healthy. Their AFFO looked pretty solid, and we don't know what their overall occupancy rate is. So with that said, I think it would be fair to categorize them next to Equinix because they both have some things that are bright and some other things that are just absolutely smelly and disgusting. So it kind of evens out to a grade of an average. And you're going to have to excuse me for my manners because I didn't say whether or not I owned any of the companies that we talked about so far. And I will tell you this right now, out of the 3 companies that we talked about in this upcoming 4th one, I don't own any shares. I don't have any skin in the game. Well, this next one is going to be WellTower. They're in the real estate business of healthcare centers. So when you think about senior homes, urgent care centers, and etc. And their ticker symbol is WELL, which I think is pretty cool. They're headquartered in Toledo, Ohio. Their REIT grade is 100 out of 100, which is phenomenal. Right now, if you want to buy 1 share of WellTower, that's going to set you back $133, which I think is okay for a REIT. That's not too expensive. Their market cap, $83 billion. I think that's pretty cool. Their trading multiple is a little high, but I think that's because they're specifically operating in an industry where it's going to thrive, at least for the next 10 to 20 years. As all the baby boomers and millennials get older in age, healthcare access and necessity is going to grow. So I think WellTower has a very bright future for them in terms of their intangible growth story. And when we take a look at their total return for the past 10 years, not exactly the prettiest picture at 161%, but as you can see, in the past year and a half or so, their stock price is skyrocketing. So I think, do I see that trend reversing anytime soon? No. I think as we go forward, this price right here is only going to grow bigger and bigger. I could be wrong because I'm an idiot, but that's just what I think. And the dividend profile, oh man, right off the bat, I can see that they tend to cut their dividend when times get tough, like right here in 2006 to 2007, and then again during the pandemic, but they are reversing course. And they are growing it finally. Right now, their dividend yield is 2%, which for a REIT, I would argue is pretty low. For me, I would steer clear just for that fact alone. If the REIT does not pay at least 3%, I don't want it. Because you buy into a REIT because of their high dividend yield and with the disadvantage of having to pay more taxes on it. Unless, of course, you buy into it in a tax-sheltered account, such as like a 401k or a Roth or whatever it is called in your country. Unless you do that, then you have to pay significantly more taxes for those dividends. And so if I'm going to be doing that and be penalized, I want to see a dividend REIT that's juicy, and it's not. They are offending me. I am triggered. My pronouns are cheese and hamburger. I am just pissed off at this 2%. But is the dividend going to be sustainable? It absolutely is at 65%, and they're growing it year over year, 9.8%, which is kind of misleading. I think this number right here is more valid and truthful. Past 5 years, they've been growing it at a rate of 0.1%. I'm going to go with this number because, as we can see in their history, they do not hesitate to cut the dividend when the times get hard. So overall, their dividend profile, I would argue, is below average. Is that fair, or am I being harsh? Anyways, whatever. As we look at their financials, their FFO is kind of all over the place. Sometimes it goes up, sometimes it goes down. That shows me the stability of their finances is going to be a rocky relationship. However, for the past 2 to 3 years, things are looking pretty bright for them. And when we take a look at their occupancy rate, it is sitting at 85.8%, which I would argue is not good. At one point, back in 2015, WellTower was able to boast about a 91%. However, since then, it's just been declining, so I don't know what's going on. And they reached their lowest during the pandemic at a 78%. So it shows me, like, when times get hard for this company, I think the reason why their FFO suffers and their dividends suffer is because the clients in their portfolio probably have to close shop, or they can't afford to run their operation anymore. So that is something to be mindful of. So their FFO, I would argue, is below average, occupancy rate below average, dividend profile below average. So when it comes to WellTower, I feel like the facts speak for themselves. I mean, their total return was not that pretty either. So Is it fair for me to put them into the category of E? I don't think they're F. I think F is going to be something that is just atrocious and is racist and is ugly. I don't think that's WellTower. However, I also don't think that they belong here next to Equinix and American Tower. So I think for now, I'm going to put them into the category of E. The next real estate stock is going to be Simon Property Group, ticker symbol SPG. They are in the business of renting out shopping malls, outlet centers, community centers, office buildings, and hotels. A pretty diversified portfolio, a jack of all trades and a master of none. Although I would argue most people associate Simon with fancy and premium outlet malls. At least I would. And their REIT grade is an 85 out of 100. Every category got a perfect except their debt. The way that they're managing their debt, especially when you consider their EBITDA, is the worst thing in the world, a 0 out of 15. So that is something to be mindful of. Right now, each share is going to set you back $175. Market cap is $57 billion, so it's still a pretty big company. Their trading multiple, I would argue, is pretty small. My goodness, a 13.5. And that's when you take into consideration how their stock price has just been ballooning, which tells me even about a year and a half ago, their trading multiple was really low, and that's evidenced by their 5-year average. Their PE ratio, aka the price to diluted FFO, is 11.6. Really low. And I think that's because maybe like 5 years ago, I remember reading Wall Street Journal articles about how Amazon was going to absolutely replace and destroy shopping malls. And then when the pandemic happened, look what happened to this company, right? I mean, every business out there suffered initially, and then they had rebounds depending on their timeline. But for Simon Property, they got absolutely hammered. They went down to $35 a share, which everybody was fearful around this company. So if you bought into Simon Property, I would shake your hand and buy you a beer because you're probably really happy. When everyone else was absolutely fearful about malls disappearing, and you bought into it at $35, and now you're a happy man with a 4-inch wiener because it's $175. Congratulations, sir. See, that's what I like to do. I like to buy high-quality compounders when everyone is fearful about that company and it goes on a sell-off. I like to buy it up, especially if the trading multiple is low and their financials look good. And speaking of which, their dividend yield is 4.7%, which means their payout is $8.40. Finally, a juicy dividend profile. Is it sustainable? Because I don't care if it's 4.7% if they can't manage to keep up their dividends. And when we scroll down and take a look at that, yes, it's absolutely sustainable. For a REIT, I would argue anything less than 80%, absolutely healthy and sustainable. When it reaches that territory of about 85%, especially for a REIT, that's when it starts getting a little hairy and a little sticky. And when it reaches 90-95%, you got to pump the brakes, drink some water, pull out Google Maps, and you might want to change destinations because this company is not going to be able to afford their dividend. But anyways, they're growing their dividend at a rate of 9% year over year, which is pretty good. However, if we zoom back up right here, in their dividend history, we can see that when times are tough, Simon Property, they do not hesitate to cut it in order to save their business operations, which makes sense on paper, but as an investor, you hate to see it. So I think their history of cutting that dividend, it kind of docks points from this high dividend yield being so cute and so beautiful. So instead, I look at it as if it's like a 2% dividend yield because of these dividend cuts. And as we scroll down even further and take a look at their FFO, you can see that it's kind of steady and on a flat line. So I would argue their FFO is not exactly growing at the biggest rates that makes this company like a juicy compounder, but it is growing, I guess, because for the past 3 years, it's growing at a rate of 2.8%. The reason why I'm not saying this number is because we can't really count that pandemic year-over-year trend because that's an outlier, right? If you include outliers, then it gets a little weird. But for the past 3 years, I think this is a more accurate assessment of this company. 2.8% growth of their quote-unquote free cash flow. Their debt to assets, I mean, as we talked about earlier, atrocious. This is really bad. They need to do better. When we take a look at their occupancy rate, though, this is beautiful. This is actually really solid at 96%. So their FFO, I would argue, is slightly average. Occupancy rate way above average. I think this is solid. Their dividend profile is a hit or miss. It depends. Are you able to turn a blind eye to not receiving a dividend payment for a quarter or two when things get sticky for this company? If you are, then you're probably going to be happy with a 4.7% dividend yield. However, for me, I like when things are consistent, reliable, and are predictable. However, for this company to be cutting their dividends every 5 to 10 years, does it fall under that definition? Well, I guess it does, because you can rely on them to cut that dividend when times get tough. All things considered, when it comes to Simon Property Group, I don't know if they belong up here in C. I think as of right now, we're going to put Simon Property Group in the category of D. I can tell you this right now. If I was ever a university professor, I would be very tough at grading, because some of you watching this video, I already know the vein that's popping up on your forehead is about to burst from how angry you are and how much you're typing. You're leaving me a comment like, "You're an idiot. What do you know, you stupid butthole? Don't tell me that this company is a D because I'm investing in it." I hear you. That's a valid call out, but I don't want to just give away free cookies and say every company belongs into an S. Because then if you say that, then where's the special title of being an S tier company, right? So let's move along to the next company. And I think that's just something that's weird about me. In my personal life as well, off the screen from YouTube, I just hold myself to ridiculously high standards. You don't see it, but I am an absolute perfectionist whenever it comes to my craft, my hobbies, whatever I do. I just don't like demerits, deficits, or anything that's below the standard. It's just the way I am, and that's why my entire life I've always been an overachiever, and I'll talk more about that in my life and investing story video. That's coming up soon. I'm working on it, I promise. The next company is going to be Digital Realty. They're in the business of renting out data center facilities for their customers to operate their data centers in. That way it has the perfect air-conditioned, climate-controlled environment so that their servers don't get overheated, etc. Anyways, currently they're trading for about $183, and it seems like most of these REITs trade for around the same price. So you just got to pick your poison. Which one's going to make your PP smaller? Which one's going to make it bigger? Market cap is $60 billion. Trading multiple is at 27, and it kind of makes sense for what they're doing, data centers. I think that's very similar to Equinix as well, right? 27. Their REIT grade is 100 out of 100, which I would argue absolutely beautiful. This is exactly what you want to see and helps you to sleep at night when you invest into a stock. As we scroll down and take a look at their dividend profile, it's like stubbing your toe when you walk in the dark. A 2.6 dividend yield. Not the highest, not the prettiest. $4.88. Is it sustainable? The payout ratio tells us it is, a 73%. When you consider their FFO, are they growing it at a rate that makes you happy? A 0% year over year. And when you look at the past 5 years, this number right here, $4.88, is growing at a rate of 2% year over year. So their dividend profile, I feel like I'm being exaggerative. It's not ugly, but it's not beautiful either. So let's just go ahead and shake hands and say that it's average. If I saw this on any other company, I would say this is average. But in the realm and perspective of a REIT, I would argue this is below average. I mean, would you agree with me? They're not growing their dividend. The dividend yield is below 3%, and it's just, I don't know, not a fan. And as we scroll down and look at their financials, their FFO, finally, this is beautiful. Past 5 years, growing at a rate of 8% year over year. They posted $2 billion. I think that looks pretty good. This is a call out. Occupancy rate. How many of their warehouse facilities are being currently occupied and used and have a paying customer giving them rent money? Well, that's 83.9%. That means they're missing out money on about 16% of their properties. Not good. So when it comes to Digital Realty, I really liked their FFO. I did not like their occupancy rate, and their dividend profile was slightly below average. So I think, is it fair for me to put them into the category of D for now? And upon further review, the referee has found no penalty. Just kidding. I looked at Equinix, which is one of their peers, doing the exact same thing they're doing, and I think they don't deserve to be in the category of C, because Equinix and Digital Realty almost look exactly the same when you put them next to each other. It's like two nipples on a chest. So I think they're going to be dropped down to the category of D. And then American Tower is now the standard for what makes an average REIT. All right, beautiful people. The next REIT is going to be Public Storage. ticker symbol PSA, public service announcement. Make sure you floss your teeth. Their grade rating is an 88 out of 100. They're basically in the business of renting out storage units for people that have way too much accumulated junk in their house to the point where they don't even use their car garage. It's just filled with boxes of crap and junk. And then they have an overflow, so they go to public storage and rent out a unit to put additional crap into. It's a business that sells itself. As Americans, we overconsume. So that's basically what they do. They're currently trading for just shy of $300 a share. Market cap is $52 billion, so a pretty big company. Their trading multiple is a 17.8. Total return for the past 10 years, 133%. Dividend profile, 4%. Very juicy. I like what I see. You get paid $12 in dividends per year. I like it. But I don't like this part right here. Their dividend growth year over year was flat at 0%, but for the past 5 years, it grew at a rate of 12.5%. And I guess I should explain why this is happening right here, why some of these companies are barely growing at year over year. It's because right now, in high interest environment, real estate companies are struggling because when the rates are that high, it squeezes their profit margins and it makes their business to operate a little bit more difficult because they need to take out loans in order to acquire more properties. Does that make sense? And so as the rates are high, it trickles down and hurts their bottom line. So as a result, they're not able to afford a bigger dividend year over year. So I think what they're doing is public storage is playing it safe by trying to keep the dividend sustainable instead of being ambitious and like idiots increasing it and not being able to afford it and then having to cut it like we saw earlier with that healthcare company. What was it? WellTower. That's what happens. So instead, they're having the foresight to think to themselves like, okay, let's not get ahead of ourselves and increase it because we don't know if we can sustain that growth. So I guess if you pump the brakes and think about it that way, it shows you that possibly the leadership team is responsible. The payout ratio says it's sustainable, but the growth, the lack thereof, not a fan. But the dividend yield, I would argue, is juicy. For a REIT, that's what you expect to see. And as we scroll down and take a look at their finances, their FFO for the past 5 years growing at a rate of 15% year over year. It's pretty good. However, for the past 1 year, it went down by negative 1% because I just told you, right? The inflation is not just hurting you in the price of eggs and milk. It's also hurting a lot of businesses and industries across the board. Their occupancy rate is kind of shocking to me at a 92.7%. Some reason in my head, I felt like it would be a lot lower, but I guess when you go to a public storage, I'm assuming most of them only have about 8 units out of 100 to rent out. So I guess that's pretty impressive. But when it comes to public storage, I liked their dividend yield. Not a fan of the lack of it growing. FFO seemed okay as well. I know it didn't grow year over year, but in the bigger picture, it looked pretty solid. Occupancy rate could be a little higher, but I think that's going to earn them a grade of being into the C. Now, here's where I'm coming from. If Equinix and Digital Realty, like, yes, we can turn a slightly blind eye, maybe needing glasses, but you choose to walk around without wearing them because you don't want to look a certain way. If their occupancy rate was at least a 90%, I think they would earn the right to be next to public storage in the category of C. But remember, their occupancy rate's disastrous. So, as of right now, things are going to stay the way they are. All right, my balding friend. The next one is going to be Realty Income Corporation. This is a company, full transparency, I am in love with, I am invested into, I think maybe thousands of dollars into this company. I made a deep dive analysis video talking about why I love it. If you want to know more, watch that video. They're basically in the business of commercial real estate. So when you think about Dollar General, Walmart, Target, Best Buy, they need to rent out that building to operate that store, right? Well, they're going to come to Realty Income, and that's who rents it out back to them. And their REIT grade is 100 out of 100. My goodness, my butthole was getting sweaty. How dare I say I own so many shares of Realty only for them to have like a REIT grade of like a 60 out of 100. That would be embarrassing. But all things considered, Beautiful. This is exactly why I believe in this company. And as we take a look at their share price, right now it's $55, which I would argue they are absolutely undervalued right now. And you might beg to differ, but that's okay because your wife is also a walrus. Anyways, their market cap is $48 billion. I'm sorry, I didn't mean to offend you. If your wife is actually overweight, I was just joking around. I didn't mean to step on your toes. I'm just joking, okay? Their trading multiple is at 13.4. So far, I would say not too bad. Realty Income's total return for the past 10 years, not good. This is ugly. This is absolutely horrific, 85%. And that's because the REIT industry, the pandemic really shoved a pineapple right up their booty hole. But if they can rebound from this high interest environment, why can't Realty Income go up to $78 a share or even $80 a share? It's just right now, they're just getting one obstacle after another and a speed bump after another. So I'm not trying to explain away why they're not performing as well as they are, but you do got to consider the macro environment conditions that are preventing this company from skyrocketing. Anyways, their dividend yield, absolutely juicy. Absolutely beautiful. You tell me, are you not going to be happy with receiving a 5.7% dividend yield? My goodness. And the fact is, they pay their dividend every single month. And they've been doing it longer than you've been alive. I think it's like 50-something years. Pretty impressive. So finally, we have a dividend yield that is just shy of 6% and is absolutely a darling. And as we scroll down, is it going to be sustainable? Wow, color me shocked. 76%. It's healthy and it's sustainable. When you compare that to the sector average, 75%, yes, it's healthy. And they are growing it, my friends. They grew it year over year at a rate of 3.2%, which keeps up with the traditional rate of inflation. Obviously, in the past few years, things are wonky, okay? It's because we were pumping and printing money without thinking about the consequences. But a 3.2% is consistent across the board for the past 5 years. So not only is this yield 5.7%, it's sustainable, and unlike the other REITs, they're growing it. I'm telling you, Realty Income sells itself. The investing thesis writes itself. As we scroll down and take a look at their finances, their AFFO, a beautiful picture. Who's going to argue with me right now that Realty Income is ugly? Who's going to tell me that? Because as I scroll up, should I remind you of their trading multiple one more time? Think about your favorite company in the stock market. It might be Nvidia, it might be Intel, it might be PayPal. Look at their trading multiple. It's going to be at around like a 30, a 40, or even a 50. Realty Income is posting a 13.4. Keep that number in mind because when you take a look at the REIT equivalent of the free cash flow, look at how it's growing year over year. Past 5 years, their free cash flow, aka the adjusted funds from operations, at a rate of 31% year over year. My goodness gracious, those are some bonker numbers that you would only see from a company like Google, Amazon, Meta, Tesla. You would never dare to expect that coming from a commercial real estate company. That's why I'm invested heavily into Realty Income, and I'm okay. I feel okay about the company. Their occupancy rate just shy of 99%. And this is what I want to call out. If you're not paying attention, please put your pants back up and pay attention. During the pandemic, most companies, their occupancy rates dropped, right? Like driving a bus off a cliff. Let's see what happened to Realty Income. So in 2019, they posted a 98.6%. The following year, during the pandemic, color me shocked, 97.9%. It literally dipped by about 1%. And then the following year, it rebounded. This is a company, through the bad times and the good times, they thrive. They sail their boat like they've been doing for the past 60, 70, 80 years. And their dividend is just growing and has a dividend yield that makes up for your short stature. If you're anything less than 5'7", then this is a company that you should potentially look into because it might magically add an inch or two to your overall height. So when it comes to Realty Income, you can go ahead and call me biased, or you can look at my YouTube profile picture and call me ugly, whatever you want. I think Realty Income speaks for themselves. Their numbers do the talking, especially when we consider these three metrics. I think Realty Income is the golden standard of what makes an S-tier REIT. So we're going to go ahead and place them right here. They're the champion of all the REITs that we have talked about today so far. If you disagree with me, you got to let me know. Write a comment. The next real estate company is going to be Crown Castle, ticker symbol CCI. They operate cell towers and fiber networks based in the US. So they're basically doing the same thing American Tower is doing, but instead of operating internationally, Crown Castle exclusively runs in the US. When we look at their REIT grade, they have a 73 out of 100. They have a few things that are red flags. So when we take a look at it, we don't want to get too ahead of ourselves with the payout ratio, their debt, and I guess their FFO. But as of right now, each share of Crown Castle is about $90. Pretty affordable, I would argue. Market cap is $40 billion. Their trading multiple is really low at a 13. And their dividend yield, this is ridiculous because their dividend yield is what I would expect from a REIT. 6.9%. Beautiful. Absolutely beautiful. But is it sustainable? That's the bigger question, right? The payout ratio right now is a 92. Which means it's getting up there. Any higher, and you might want to raise the flags and be like, hey, I don't know if this dividend's going to be affordable. And that's why year over year, they decided not to grow their dividend. And they're pumping the brakes. But for the past 5 years, they did grow it at a rate of 6% year over year. The payout, a little high, friends and family. The dividend yield, pretty juicy. But will it be juicy in the next 2 to 5 years? It depends. And as we look at their financial situation, their AFFO looked pretty solid up until this past year, where year over year it declined by 7%. So they're running into operational issues, and their largest tenant, which is T-Mobile, makes up 35%. We don't know what their occupancy rate is. So all things considered, if Crown Castle is able to reduce their payout ratio to at least in the ballpark of about 80 to 85, then their juicy dividend yield of 6.9% would be almost perfect. However, their FFO did shrink year over year, and we don't know what their occupancy rate is, so we're going to give them a pass on that one. So I think all things considered, is it rude? Is it fair for me to place it next to American Tower? Like, I know Crown Castle's dividend yield is much higher, but just like them, it didn't grow year over year, and their FFO went down year over year. But the difference between the two is American Tower's debt is slightly better, and their payout for their dividend is a little bit more healthy. But I still think because their dividend yield is so high, it makes up for the fact that their operations are running through some sticky bumps right now. So I think right now we'll just put Crown Castle in the category of a C. The next REIT is going to be VICI Properties, ticker symbol VICI. They operate real estate in the Sin City, aka Las Vegas, entertainment buildings and properties such as casinos, bars, hotels, and nightclubs. So if you're bullish about the future of Las Vegas and you are certain that people are going to flock towards Las Vegas to spend all of their money, then this is a company that probably aligns with your moral compass, right? The REIT grade is a 92 out of 100, and the reason being is they're docked quite a few points for their lack of history on the stock market, which, by the way, I don't know if you know this or not, but VICI was a spinoff from Caesars when they went through a bankruptcy dilemma. VICI was born from that, so their history, shaky foundations, to say the least. Their price right now is about $30 a share, market cap is $31 billion, and their trading multiple is very low. Super undervalued in my opinion, just from these metrics alone, and very affordable as well. But let's see what their dividend profile looks like. Their dividend yield is quite juicy, 5.7%. I like what I see. This is good. I like it. Payout says it's sustainable and it's healthy, and they're growing it at a rate of 8%. This number right here, $1.73, year over year, growing at a rate of 8%. So their dividend profile, I would argue, looks pretty good. And the dividend yield, quite juicy. And when we scroll down and look at their financials, their AFFO looks pretty amazing as well, growing at a rate of 30% year over year for the past 5 years. I think that's pretty impressive. Occupancy rate, wow, friends and family, 100%. Okay, so I think their numbers speak for themselves. So when it comes to VICI, I think they are a living testimony that Las Vegas is thriving. Despite people saying, oh, we don't have enough money to afford groceries, on the other end of that spectrum, there's people that are gambling their money and having a lot of fun in Las Vegas. And yeah, so I think based on their numbers, they are in the category of S tier. They earned it. VICI is surprisingly a pretty solid REIT. So Realty Income and VICI are right next to each other. The next REIT is going to be WP Carey. They're in the commercial real estate business, very similar to Realty Income Corporation. Their REIT grade is a 58 out of 100, and that's because their FFO is not looking too bright, and their dividend growth, I guess this ruined it for us. There's a spoiler alert, it's probably not growing. Anyways, their share price is sitting at $56, or just shy of 57 market cap. This is probably one of the smaller companies that we have talked about today at $12.4 billion. A 12 trading multiple, that's really low, but I guess in accordance to their sector average, they're slightly above it. Surprising. And as we scroll down, their dividend profile, their dividend yield is 6.2%. We're going to round up. We're going to give it to them. Can we do that? Can we do some charity here? 6.2%. Pretty good, pretty juicy. I like what I see here. Let's see. The payout, is it sustainable? Yes, it is. Is their dividend growing the past 5 years at a rate of negative 3.8%? But they finally were able to grow it year over year by 2.3%. It looks like during the pandemic, they were ambitious and continued to increase it, and then they realized, all right, this is not sustainable. So when did they make that call to cut it? I guess at the end of 2023, they decided to cut their dividend. So cutting the dividend, as you already know, not a fan of. However, it does look like going forward, it is sustainable. So we'll give that to them. So the dividend profile, I would argue, is slightly above average with a pimple or two, in the middle of their forehead, a giant zit because of the cut. AFFO is going in the right trend, I would say. Year over year went down by negative 7.9%, very similar to Crown Castle. The high interest environment is squeezing the balls of the real estate sector, I'm telling you right now. But usually it grows at a rate of 5.9%. So their AFFO, I would argue, is slightly above average, but with the recent decrease, I guess it just bumps it down to the average category. Their occupancy rate is pretty good. 98.8%. So when it comes to WP Carey, I would argue things looked pretty good. I mean, besides the dividend cut, I think everything else looked pretty solid. So with that said, I think right now, WP Carey is going to be in the category of A. And just to refresh my memory, let me take a look at Prologis one more time to see if they belong in the same tier. The dividend yield for Prologis is 3.2%. They also cut their dividend very recently, but the difference is they're growing it at double-digit rates. But what about their financials? Their financials look pretty good. Occupancy rate. So I think, is it fair for me to deduct a grade letter from Prologis and put them into B? Or I think they both have something going for them that kind of balances things out. For WP Carey, I would say it's their sustainable high dividend yield. And for Prologis, I would say it's the growth of that dividend. It's not as juicy at about 3%, but their occupancy rate looks pretty good as well. So I think as of right now, I think I'm going to keep these two in the A tier. But in all honesty, I should be putting Prologis right here. But for now, we'll just put them in the A. Maybe in the final review, we'll shake some things up. But as of right now, this is the way things stand. The next real estate company is going to be Triple N, which is a very clever ticker symbol because it stands for the triple net lease. Essentially, it's a commercial real estate company where the customer has to pay for to maintain the building rather than the real estate company having to do that. So that's what a single net lease is kind of defined as. It's a huge advantage for the real estate company, not so great for the customer. But the REIT grade is a 95 out of 100, which is pretty good. Their debt is the thing that's deducting 5 points from them. Share price is $40. Market cap, this is the smallest company so far that we talked about, 7.6 billion. Their trading multiple is a 12.2. Pretty low, I would say. Very undervalued in terms of valuations. When we scroll down, their dividend profile looks pretty good to me. A 5.7% dividend yield, which let's see, is it growing? Yes, past 5 years, growing at a rate of 3%. The payout ratio tells us that it's sustainable and healthy. So their dividend profile, I would argue, above average with a juicy dividend yield. As we look at their financials, their AFFO going in the right direction, good trend, and year over year it actually increased instead of going down. Past 5 years, it grows at a rate of 9.4%, which I think is pretty good. Their occupancy rate is 99.3%. This is really good. I am actually pleasantly surprised. I did not expect that from Triple N. This is a company that has been on my watch list for quite some time, and then I decided to delete them to make room for another company. I can't remember who it was, but yeah, it just reminds me of why I was eyeballing this company for a while. So when it comes to Triple N REIT, I think it's a disservice to categorize them into the A tier because there was nothing in their metrics that signified a bad or red flag. Yes, their debt wasn't exactly the best, but I think they earned the right to be next to VICI and Realty Income. I mean, is that fair? I think their numbers speak for themselves. All three of these companies, very similar numbers across the board. And the next company is going to be Stag Industrial. They're in the real estate business of warehouses, fulfillment centers, factories, and transportation hubs. This is a company that was booming alongside with the e-commerce industry. Their REIT grade is 100 out of 100, which is pretty impressive. Market cap is $6 billion, currently trading for $34. Their trading multiple is a 14.7. It's pretty low, I would argue, and I forgot to do the total return for the past few companies, but their total return is 132%. And their dividend profile, it looks like their yield is juicy at 4.2%. But here's what I want to call out. From 2014 all the way to now, their dividend is growing basically at less than 1% year over year. So their dividend growth, not juicy, but the yield, juicy. So depending on how and when you buy into it, like if you buy into Stag when they're on a sell-off, way below their intrinsic valuation, then I would argue that's a good bang for your buck. It makes up for the fact that the dividend's not going to grow that much. But to buy it when it's overvalued, I just don't know if that's the wisest thing. But the payout ratio, pretty sustainable. And then when we look at their financials, their AFFO is growing in the right direction and trend, double-digit rates for the past 5 years. You like to see that. Occupancy rate, a 97. I think this is pretty good as well. So when it comes to Stag, I feel like their only blemish is the fact that the dividend is not growing at a rate that is impressive. Less than 1% year over year, I don't know about that one. But on the other hand, their FFO and their occupancy rate were pretty good. So I think that's what qualifies a company to be in the A tier. They're above average in almost all other metrics, but the growth is what is going to hold them back. Is that fair? Stag Industrial, A. And the next company is going to be Sabra Healthcare. This is a REIT that I see mentioned all the time, frequently on different investing forums and on social media platforms. So it must be popular for one reason or another. They're basically in the business of mental health clinics, nursing homes, and hospitals, owning that property and then renting it back out to anybody in the healthcare space. Their REIT grade is a 50 out of 100. It looks like their FFO is atrocious, their payout ratio is getting a little high, and their debt is not looking too bright. They're currently trading for about $17 a share. Market cap is $4 billion. Trading multiple is a 12. So on surface value, you would argue, it looks pretty good. When you look at their 10-year total return at 26%, I'll tell you, that's something else. I'll tell you that right now. Oof, scrolling down, dividend yield is 7%. So I'm going to tell you this. This Sabra is literally the definition of a value trap. You look at it because of the dividend yield, and then you find out, like, man, my money is not growing. A 7% dividend yield, I would say, is juicy, but as I say that, I'm looking right here, and I can just tell that the dividend is not growing, and as a matter of fact, they cut it very frequently. This is not what you want to see. In the past 5 years, they've been decreasing it year over year at a rate of negative 2.8%. Payout ratio is a little high. This is not looking good, guys. Their dividend profile, I would conclude, way below average. And as we look at their financials, their AFFO is kind of all over the place. They've reached their high back in 2018, and since then, it's just been on a steady, slow decline. And when we look at their occupancy rate, will it make up for their other blemishes? No, an 84.7%. That's not good. About 15% of their properties are idle. They're not generating money for them. So all things considered, when it comes to Sabra Healthcare, is it going to be weird and rude of me to put them right next to WellTower, another healthcare REIT? I mean, it just shows you that these two companies are just not that bright and that good of an investment. They might be a good company to work for. They might be operating in a booming industry, but as a REIT, not exactly the best investment choice. Just my opinion from looking at the numbers. The next REIT is EPR Properties. Anything to do with experimental or entertainment, that's what their real estate portfolio consists of. They have water parks, ski resorts, museums, gyms, and even bowling alleys. That's EPR in a nutshell. Their REIT grade is an 83 out of 100. Their FFO and their debt is what is holding them back. Share price is $47. Market cap $3 billion. Wow. Their trading multiple is a 9.9. The first one on our list to have a single-digit trading multiple. That's really low. Their total return, not exactly the best thing, and that's because during the pandemic, when you weren't allowed to go to certain business establishments, that probably really hurt EPR. And as a matter of fact, their stock price crashed all the way down to about, $15 a share at their lowest. But since then, they've been making a pretty solid recovery and rebound. So we'll give them that. Their dividend yield, I would argue, is pretty good. It's 7.3%. But look at their history. This is pretty crazy. It goes on a cliff dive every so often. I mean, the Great Recession, 2009, makes sense. But then it happened again in 13, and it happened again during the pandemic. They got rid of their dividend altogether. So their dividend profile, not that bright. EPR does grow it when they can. And the payout ratio is pretty good. But the cuts, this is pretty bad. This is pretty ugly. As we look at their financials, their AFFO all over the place. Yes, the past 5 years looks amazing, but that's because of the pandemic outlier. But what is surprising is that their occupancy rate is 99%. I didn't see that coming. So when it comes to EPR, what really threw me off was their occupancy rate being as high as it is. But their dividend profile is, it's kind of a miss. Like, yeah, the dividend yield is really high, but certain quarters, every so often, you're not going to get a dividend. And their FFO was all over the place. So I think that's what makes a company kind of like in the D or E category. Is that fair to say? I think their history and their numbers, it places them into the category of E, right next to the two healthcare REITs. I'm going to be honest with you right before we do the last one. My voice is shot. I've been recording for the past 2 hours and 20 minutes. So when I edit this, it's going to be the final product. It's probably going to be around an hour, but man, that's a lot of talking into a microphone. Anyways, the last REIT, this is the 16th real estate company, is going to be Park Hotels and Resorts. Their real estate portfolio consists of unique boutique hotels and resorts in the luxury space. So you're not going to see a Motel 6 or a Red Roof Inn. Every hotel that they operate, to stay there for a single night, you're talking about like $250, $300 a night. Something like that. Of course, I think there's some outliers where you can stay a night for like $100. But for the most part, the bougie, the rich folks, their REIT grade is a 76 out of 100. Not exactly the greatest. That's like just a hair above a letter of a C. They're currently trading for about $13. Market cap $2.8 billion. Their trading multiple, this is stupid. This is so low, a 6.3. That's ridiculous. And as we assess their dividend profile, I had to do a double take, an 18.9% dividend yield. That's pretty crazy. But as you can see, their history, They have a history of increasing it, decreasing it, increasing it, and then sometimes just getting rid of the dividend altogether. Their dividend payout ratio is 120%, which tells me that this dividend is going to be cut again. However, when they're able to afford to do so, they do grow it at a very ridiculous rate when they're able to do so. When they're not, they don't hesitate to cut it. So I look at this and I don't even say that it's juicy because you don't even know if you're going to get a juicy yield or get a no yield. And as we look at their financials, their FFO is probably the ugliest one that we've seen today. They were in the red altogether during the pandemic and in 2021, and their occupancy rate is just atrocious as well. During the pandemic, it dropped down to a 26%. Not good. Yes, they've recovered since then, but man, not good. So as we wrap up the best dividend REITs ranking tier video, I think we saved the best for last because this one is going to be placed right here in S tier because I think their rebound and turnaround story is just, it's believable. I'm kidding. I think Park is going to earn themselves a grade letter of an F all by themselves. And as we take a look at this board, I think we do need to make one final adjustment. I think all things considered, I think Prologis should belong here in the B, which means WP Carey and Stag are going to be in the A tier. But for the most part, this is what I concluded. What do you think? I do want to hear your thoughts and opinions because I'm one of those guys that's always open to feedback and constructive criticism, and I love hearing other people's opinions. Anyways, with that said, thanks for hanging out with me. I love you, stay safe, and I'll talk to you next time. Peace.